So this is the S&P versus the high yield bond. So above is the S&P 500. So the pen below is the high yield bond. So ticker symbol is a HYG, and this is the weekly chart. So apart from the very obvious thing, like this is the so-called the divergence. So we definitely get a higher high here, higher high, another higher high. But look at the high yield bond. It's just flatten, flatten, and also flatten. So the high yield bond actually just give us some an early warning for the market. And one of the main traits of the high yield bond is because it is very sensitive to the liquidity. So majority of the traders or investors just use a high yield bond as like a risk on, risk off tools or indicator. But also, high yield bond is actually very sensitive to the market liquidity. And I think in 2014, 18, and currently, we are in the monetary tightening environment where the Fed actually conducting the tapering program and also the tightening as well. And possible we will experience the tapering plus the tightening in this year as well. So in this year, the Fed is actually just schedule the tapering program is to end in probably next month in March. So means that in short, they will just stop buying the bond. So that will stop like next month. And in 2014, it took them about 10 months to taper the bond buying program. So this is a relatively fast pace of the tapering program. And subsequently, they also talk about they will probably do the tightening of the program, means that they want to unload some of the assets. So that's to shrink their balance sheet, means that they want to start selling. So tapering is just stop buying, tightening is start selling. So once they start selling, like in 2018, then I think the market will definitely feel a lot more pain ahead. So that's pretty much it. Tally with the Fed's direction. So if you look at the high yield bond here, so just before the reaction happened in 2015, there's a 12% of the correction. So there's a market correction of the 12%. But look at this. Prior to that, we already see that the high yield bond actually experienced some meaningful pullback. Look at the one that highlighted in pink. So this is meaningful pullback or like a change of character. So unlike the index, look at this sort of the magnitude. So they already told us that something is not right in the market liquidity, and eventually the market will catch up. And here goes the market correction with high volatility ahead. So going down, going up, going down, going up, and eventually it's just settled. So this is another correction in the high yield bond itself. And in 2018, that's the tightening of the monetary keep the QE. So the Fed actually just do the QE tightening. And at that time, you can see that in 2017 is still very much a bull run. At least the index is just keep going higher, high, higher, low, higher, high, higher, low, and eventually it's just a climatic run. But look at the high yield bond here. The high yield bond actually experienced some meaningful correction. So this is the meaningful correction, and eventually it just kind of forming a trading range. Is topping already. Is just like months before the meaningful sell off. So this is another 12% market correction in 2018. I think that's related, at least coincides with the China-US trade war news. Okay, but certainly this is a lot more to do with the Fed tightening of the QE. So you can see that this is a prolonged trading range, quite painful. So lots of volatility involved to the downside, to the upside, and then this is the Christmas sell-off breakdown, and then V-shaped bounce back. But still, there's a trading range, a big trading range, just like in 2015, 16. So big trading range. Right now, in 2022 this year, I think just in started in November or even earlier, like in August, the Fed actually talked about the tapering, but it's a lot more concrete in November, and that's why we see that there is a sell-off happen in November, especially in the growth stocks, and just prior to the sell-off. So the sell-off happened actually this year. So this is the index. So that's starting in January this year. The 12% market correction just happened a few weeks ago, like last month. But prior to that, where I talk about in session 16, 17, like 10 session 10 weeks ago, so about 2.5 months ago, we already see there is a pullback, a meaningful pullback happen in the high yield bond. So that actually spells out there's trouble ahead for the market liquidity. So that actually ties in very well with the Fed's monetary tightening program. So tapering, tightening, tightening, tapering. So I think it's just sort of coincides or in line with the fundamental very much. So what can we expect in 2022? Well, at least we have a leg down. It's a change of character for sure. And what I actually anticipate is some form of the great volatility ahead. Like we got a leg down, leg up. Now it's just a reverse, like Thursday, Friday's action just reverse. Um, I think it's on another leg down to test the selling climax low. So at the moment is something like this. So we are at the selling climax, automatic rally, and secondary test. All right. So that's pretty much for the relationship between the high yield bond and also the market. So very much that the high yield bond is one of the important indicator that I think every trader should definitely monitor, and because it could really tells you something ahead of the market, like this, and also like this. All right.